Welcome to the Artisan Podcast, where we share insights from some of the world's leading minds. Today, we will look at the Canadian housing market with Harvinder Kalirai and Christopher Invidiata. Christopher is at Real Brokerage and is one of Canada's leading residential realtors. And he's seen a couple of cycles, plying the trade for nearly 4 decades. Harvinder is currently the global bond and currency strategist for Alpine Macro. Before that, we worked together for over a decade at BCA. And I can honestly say he is one of the brightest and most thought-provoking strategists I've ever known. Enjoy. So just reading the papers, it seems like the banks are falling over themselves to see who can be the most negative. RBC, for instance, is calling this the steepest decline in half a century. Not to be outdone, TD is predicting a 20 to 25% decline in residential real estate prices. So Harvinder, are they on the mark or out to lunch?
Well, I do agree with the general outlook that housing is going to have a downturn and there will be some decline in prices. The issue for debate is whether it's going to be 10, 15, 20%. And also, as we say, real estate is local. So some markets can experience much sharper declines than other markets. Some markets could be flat. Some markets could experience, 25% declines. But I do agree that housing is in store for some weakness. And from a macro perspective, the cause is fairly simple. We have a combination of rising interest rates and a central bank that's likely going to push the economy into a recession. So that's another way of saying that there's going to be job losses and the unemployment rate is going to rise. So when you take the two together, declining jobs, rising interest rates, that usually spells trouble for the housing market. To me, the bigger issue is not whether housing is going to decline, but whether it's going to pose a systemic risk to the economy and to the financial system, like we saw in the US and in parts of Europe over a decade ago.
So, on that note, you wrote a very interesting report recently, which looked at the potential implications of the housing issue in Canada and the potential for systemic risk. Maybe you could give us some of the highlights of that report.
Sure. So once again, to start off, there's bad news. Housing is going to turn down. But at the same time, there is some good news in the sense that we don't need to have a repeat of the GFC, or as we had in the U.S. and elsewhere. So on the borrowing side, on the household side, to start with, the structure of our mortgage market is quite different from the way it was in the U.S. First of all, to get a mortgage, you have to put down 20%. And if you can't do that, you have to take out mortgage insurance. Lending standards were much more lax in the US. There was no income verifications. Mortgages were made for even more than the value of the house, and that was being appraised at ridiculous levels. We don't have that type of crazy lending practices. There's a lot more prudence taking place. Also on that, we also have stress tests. Households were not, they don't get a mortgage based on the posted rate or even a discounted rate. They had to meet a higher threshold. So there was a buffer built in where households were made to be able to withstand some rise in borrowing costs. So that's on the borrowing side. And then, of course, on the lending side, we have a banking system that's relatively well capitalized. There's minimum capital requirements, and then there are buffers on top of that. And to give you a little bit of a sense of the well-capitalized nature of the Canadian banks, I'm just going to read something we wrote actually in our report. So the Bank of Canada did a study, I think it was earlier this year. And in that study, what the Bank of Canada found was that even in and I'm just quoting from our report, that even in a severe and protracted recession scenario lasting 6 quarters, so a year and a half, where Canadian GDP contracts by 5.8% and the unemployment rate reaches 13.5%. House prices plunged by 29%. So this is probably even more than the scenarios that you laid out from the commercial banks at the start of our discussion. Even if all that happens, the major commercial banks won't even come close to breaching the regulatory minimum capital requirement. So that's very encouraging. So as I said, good news, bad news. Bad news is the housing market is going to slow down, but the good news is that it won't lead to a apocalyptic type of crisis.
Okay, no Armageddon, not so bad. So that's the top-down perspective, and a little bit later we'll get more into interest rates and the economy, because those are very big macro inputs into the outlook for Canadian housing. But what I'm really interested in is marrying the bottom up with the top down. And Christopher, like I say, you have this wealth of experience. You've sold some of Canada's most expensive homes. You've seen quite a few cycles in the last 4 decades. What are your thoughts on the current market?
Well, the current market is long overdue to be corrected. So we couldn't continue with the way it was going, because you were getting 20 to 30 bids on a property. You were getting 10, 20, 30% over asking. It was too crazy. And so the government did the right thing by introducing the higher interest rates to level out, to tame the market. It's whether they're going to go too far in pushing the higher rates on the economy, on the housing market. So there are voices that are shouting out there now just to even stop raising the rates, because the effect it's already had in most markets is it's corrected the price, in some cases, 10, 20, 25% already. So the effect that it has had has been immediate. So if you look back in history, the 80s, the 90s, 2000, as rates were declining, the prices were just going the opposite direction. I bought my first home at 21% interest rates in 1981. I remember somebody saying to me, the mafia doesn't even charge 20%. So
I was on the other side of that.
Okay.
And I got to invest my bar mitzvah money at about 21%.
Oh.
I haven't seen that since.
No kidding. Yeah, awesome. So, but the truth of the matter is, the engine that drives the whole industry is the mid-market. The mid-market is the real market that we should be focused on. Because the luxury market, and I say luxury, is really homes that are over 5 million. That's the true luxury market. Most of those buyers are not using the bank's money to buy, so they're cash buyers. Those properties that are in prime areas are still being bought. They're very attractive. I think people with money still believe in the principles of owning really good assets like real estate. And we have seen it here in Oakville for sure, where we're getting multiple bids on, like our lakefront, there's less than 300 properties on the water. And land value for one property just was listed for 10.5 million, sold for 10.75 in this market, just the land. So it speaks to the liquidity that is there for those that have money and where they're willing to put their money. And so real estate's been one of the go-to investments, but more importantly, it's the prime real estate that they're going after.
So, I mean, on that, that's actually very interesting for Northland clients, because they will tend to be on that luxury end of the scale. I'm not an expert in real estate, but what I generally have read is that almost all segments of the market are down in the Greater Toronto area, except the luxury market, which really hasn't come off the peak yet. If you were just looking at the luxury market going forward, do you think it's going to catch up, or it's going to stay well bid? What are the thoughts in that segment?
Well, good question. It ties to stock values and the businesses that these owners are actually operating. So if they start to see their stocks declining, or they start to see their business, that whatever business they're in that they're running, if they start to see it starting to slow down and the curve of earning money goes down for them, they may put the brake on buying the luxury properties, and then the luxury market will start to come down.
Interesting. And I'm going to put gun to head here. You're the professional. If you looked at this market from everything that you know, and there's some uncertainties in terms of the economy and interest rates, what would be your base case in terms of the peak to trough decline? You can say that nationally, or you can just talk about Greater Toronto Area. That's kind of your specialty.
Well, when you look back historically, it's usually the equity that the homeowners have that they're losing with the decline. So just before the power sales begin and the real bleeding starts to happen, it's usually that 20%, 25, 30% that I think as a whole they look at and say, anything more than that, we're now going to start having banks losing money on their mortgages. So it's usually the capital that gets eroded in these adjustments.
Okay. So you would be more along those lines. I mean, certainly, two of the experiences that I've had is that if you look at the bursting of the U.S. Housing bubble, which we were predicting before it happened, once you got a couple years into it, like I was looking for a place in South Beach and I was waiting to pick my spot. I went to go see brokerage, looked at actual places, and basically what happened was prices just went vertical in the bubble and then stopped going up. Transactions just stopped occurring, and you really just went from the bid to the ask. So there was a 5 to 10% decline. That's it. It didn't happen in the rest of the country that way because there was bank force selling and banks forcing others, to sell. So do you think that there could be that sort of dynamic in the luxury market where, just the transactions slow, maybe you get a little bit of weakness, whereas maybe in some other areas that are more economically sensitive, where the people can't afford their mortgage payments anymore, that you'll have greater risk? Or where do you see more risk, at the high end or in what you're speaking, the middle market?
I think the mid-market for sure.
Okay.
But in the luxury market, I think those that did borrow money to fund their purchase, when things are going to be, when refinancing is involved or mortgages are coming due, the rates are almost double now what they used to be. So those payments are real. And so if the homeowner is not able to make those payments, we'll start to see some bleeding in the luxury market as well, for sure.
Okay, so maybe, as I said, it's difficult to make the housing forecast without the economic or interest rate forecast, and that's really your wheelhouse, Harvinder. So if you look strictly in terms of Bank of Canada, which is really in the shadow of the Fed, what's your interest rate outlook, both on the long bond, which is not controlled by Bank of Canada, and short rates, which is largely controlled by Bank of Canada? What are your thoughts there?
I think that not just the Bank of Canada, but also the Fed are going to probably overdo it. It just comes down to lags. You change monetary policy today based on the economic data that you're looking at today, and you're not going to see the impact until down the road. And by the time you see that impact, it's very likely that the economy is already going to be in a recession. That's just usually how it plays out. And in terms of this downturn in housing, this is part of how the Bank of Canada is going to bring inflation down. As Christopher said, that rates go up, your mortgage payments go up, and to make those payments, you have to cut spending elsewhere. And as you cut that spending elsewhere, that lower demand is going to lead to lower inflation. So this is part of the adjustment process. At the short end of the curve, in terms of how high rates could go, I would say maybe 3.5% to 4% on the policy rate. The longer rate, is of course going to be much more market determined. And of course, we know markets tend to be forward-looking. So if the markets begin to believe that a policy rate approaching 4% is going to trigger a recession, the long end is going to start to rally before that.
Okay.
So I think most of the pain at the long end of the curve is probably already behind us.
Okay.
If I could just jump in there, Joseph.
Absolutely.
One of the things that I heard, which I would love to, get Harinder's view on as well. I've heard that in the States, they're already talking about lowering the interest rates because the measurable effect has already been felt. Have you heard anything towards that?
Well, the market is pricing what we call a dovish pivot by the Fed next year. So the way the curve is priced, the peak in the Fed funds rate occurs sometime in the first or second quarter of next year. And then by the end of the next year, the market is pricing in a gradual decline in interest rates. So yes, market expectations are that the Fed is going to overdo it and eventually will have to reverse course.
Okay, because I've had a lot of clients ask me whether they should go with a 2-year renewal, a 3-year or 5-year and lock in. It's probably the biggest question that's out there.
Well, if the U.S. economy is back into a recession sometime next year, I would think that short-term interest rates are probably going to be between 0 and 1% again.
Interesting. Okay, so there's a good probability that mission accomplished and they'll start to reduce the rates.
I think the risk is that it's going to be beyond mission accomplished. It's not going to be a soft landing. It is going to be a recession. And if it was a soft landing and it's mission accomplished, you get to a nice steady state and interest rates don't need to decline too much. But if they overdo it, rates have gone up too high, then on the other side, they're going to have to reverse course a lot more as well. So rates don't go back to some steady state. They have to go below a steady state level to stimulate the economy out of the recession.
Thank you.
And so, as opposed to the U.S., Bank of Canada, where quite some time ago you worked, Harvinder, we'll look at a monetary conditions approach. So we're a small open economy, so the currency is important as well as interest rates. What are your thoughts in terms of the currency? Will the currency offset some of this tightening, the weakening of the loonie, or do you think it's going to help them tighten so they don't have to do as much? What are the thoughts in terms of that dynamic?
Great question. So right now, the Canadian dollar is actually quite cheap according to our models. The two main drivers of the currency are interest rate differentials and what we call the terms of trade, which is basically the price of the goods that Canada exports. And because commodity prices are relatively elevated, that is playing a role in pushing up the fair value of the Canadian dollar. But the Canadian dollar has actually lagged that improvement in commodity prices and in the terms of trade. So at current levels, the currency is actually providing a lot of stimulus to the economy. And it's going against what the Bank of Canada really wants. If the currency was much more in line with fundamentals, rather than being where it is at about 130, we would be sub 120 versus the US dollar. So I think relative to fundamentals, the currency is stimulative, and the Bank of Canada would need to offset that by pushing rates even higher than if the currency was firmer. And a great example of that, of the currency being so strong, of being so favorable, is that our trade and current account balances are in a large surplus.
That absolutely makes sense. I mean, it looks like it's more of a dollar move, right? I presume the dollar's going up against almost everything because people had been pretty scared and worried about a global recession. When that happens historically, it's good for the dollar. So the dollar goes up against everything. I assume it's gone up less against the Canadian dollar than the euro or the yen or anything emerging market currencies. Okay, so basically the weakening Canadian dollar means that the Bank of Canada, all other things being equal, has to do a little bit more. Let's switch back to the bottom up, which to me is just fascinating because I've done top down for most of my life, and basically everything you say, Christopher, is a wonderful lesson for me. So in the current market, you're speaking to a lot of these sellers or potential sellers. What's the psychology like right now? What are they thinking about? What are they worried about?
It's kind of twofold. So if the price of the property used to be, let's say, $1 million, and now it's at 800,000, and they're going to say, okay, if I it's too low for me to sell. If we were to say, look, if you get an offer on your home at 800,000, you can put a condition in the offer upon you now buying and making up that 200,000 somewhere else. So all through the 90s, we had to find techniques that would work in a declining market, which lasted, as you might remember, almost 7 years. So we always say to the client, how much cash do you actually want to keep aside after the transaction? And then are you buying up or are you buying down? If you're buying up in a declining market, you're going to probably do better. If you're buying down, you're going to have to start looking in areas that are a little bit outside of where you thought you could live. But nonetheless, it's the amount of cash you want to have after and the differential which you're losing because the price has dropped. So those two things really help homeowners get through the challenging times that we're in now.
Okay. And what if we look at the other side? What is the potential buyer psychology right now? I guess some people have dropped out because the interest rates have become too high, or the combination of rising interest rates and rising home prices has really taken a whack out of affordability.
Oh, for sure.
I mean, the charts are, well, they're off the charts. So if we look at the buyers, what sorts of buyers are you still seeing out there, and what is their psychology? Is their psychology, oh, falling market, I'm going to wait. Falling market, all I'm going to do is put in a stink bid and maybe something will come up. What are they thinking, and what are the buyer strategies right now?
Yeah, very good question. So the reality is there's a lot of aggression in the mind of any buyer right now because of the reality of what the market is doing. And so sometimes it's their affordability that we have to address, and sometimes it's just their aggression. And if it's the affordability issue, but they like the home that they're now potentially going to buy, and let's say there's a gap between what the seller's willing to sell today and the buyer's willing to pay or can afford to pay. We now look to the seller and say, would you be willing to hold a note, a second or third mortgage at 0% for 2-3 years to enable the buyer to make the purchase while the economy comes back and recovers? So we're going to see a lot more of that.
You have to be a little bit more creative than in the past, but luckily, you've seen these conditions in the past, so you have a nice toolbox available for how to manage through. Because I know for me, the reason why I bought a house a couple years ago wasn't, oh, I like the price or not. It's basically like within a short amount of time, I had need for 4 extra bedrooms.
Right.
You just can't rent that. Yeah. You definitely can't rent it in Toronto, but you can't rent it in Montreal either. So what about, let's take a step back, and I'd like to hear, I'll start with Harvinder, and then I'll offer the same question to Christopher afterwards. What are the thoughts in terms of fundamentals? So leave the economy, leave interest rates aside, you hear all this stuff that, new houses built have been less than household formation or immigration or whatever for a really long time. And that got worse during pandemic because we couldn't build enough. So what are your thoughts in terms of the underlying fundamentals of supply demand?
Sure, thanks, Joe. I do think that from a demographic and a building perspective, we do have a shortage of housing. I'll actually just quote you a study, not that we've done, but one from Scotiabank. So what their research shows is that Canada would need an additional 1.8 million dwellings to have the same number of housing on a per capita basis as the rest of the G7. So 1.8 million. And to put that into context, in a normal year, there's about 200,000 of new housing starts. So to catch up just to the current deficit will take years. And then, of course, that deficit can grow just from the perspective that our population is growing. Canada actually has some of the best demographics in the G7. It's not due to, say, natural domestic conditions due to high fertility rate. It's due to our immigration policies. But nevertheless, it is leading to one of the, if not the strongest population growth of all the G7. And we're starting from a deficit. So I think that the long-term supply dynamics are quite bullish for housing. Demand is going to continue to grow, and the supply isn't there. So this correction we're seeing is basically just that, a cyclical pullback.
And certainly, in a post-Trump era, for the sorts of immigrants with, engineering degrees and advanced degrees that are going to start a new tech company that's going to end up hiring 100,000 people, Canada is much, much more friendly to those demographics. You see it in terms of the overall numbers, and you see it in terms of actually speaking to students. And the U.S. is 10 times larger than us. So if there's that shift, that can really help the long-term growth for Canada and Canadian housing. Christopher, any insights from a fundamental perspective?
Well, I think we've all learned that cities get overpopulated and everybody's cramming into the one spot. And they're leaving the rural small towns without people. So I think there could be a call to action to say to the governments of these small towns and mayors to say, take 100 acres in your small town, create another village of 100,000 people around your town so that you can start building the shift away from the urban center back out to the rural pockets. And with technology today, and we learned through COVID, people stayed at home. And if you start to reinvest in rural living, but do like small villages like they're doing in England, there's a project that I think there was 10 villages in England of 100,000 per. And the government gave the land as the base, but they brought the housing prices down, I think it was like 400,000 euro. So if you want to correct the problem, you have to give the solution. And being in an urban environment, it's very hard to do that. So I think there's a call to get people back out into more of a rural setting.
Sure. I mean, again, not an expert, but from everything that I hear and see, the restrictions on zoning, whether it be environmental or affordable housing or what have you, in urban areas are increasing, not decreasing. So I think if government could get together at all its levels, which is actually easier to do in Canada than in the United States, because the cities are part of the province.
Sure.
The province can say you're doing this, and they have to. You can't really do that in the U.S. Then I think that's the solution. But there's no, that solution won't have an impact in the next 6 months. But from a long-term perspective, what you say makes a tremendous amount of sense, and hopefully things will move in that direction. It's a win-win-win for everybody. Any kind of thoughts on multi-residential? That tends to be where most of our clients are invested, besides their personal house. Any kind of thoughts on multi-residential, Harv? No?
No, that's too micro for me. I'll pass that over to Christopher.
He doesn't do that either. I don't know.
No, we do, yes. So multi-residential is, when you say that, you mean like condos?
Apartment buildings,
Yeah.
or it could be condos within a condo building.
Right, exactly. Well, there's been a tremendous amount of wealth created by investors who have bought not just one, but maybe 3, 4, 5 units in a building and participated in the rental pools. They get the appreciation by the time the building's built. Developers have relied heavily on the investor market to buy their products, lease out the units, and become almost like co-investors with them. And there's huge groups now that have been formed around this very thing. So
Okay.
that will definitely continue.
Okay, and any thoughts, not new at all in the United States, really was a big trend coming out of the global financial crisis and has accelerated this idea of single-family rental, which I read something that said a quarter of new houses last year were bought by institutional investors to rent. Has that started in Canada? Do we see that institutional investment? Instead of buying a big building, you buy a whole bunch of houses?
It definitely has started.
Okay.
It's something that I think the public, when they're aware of this, is frowning on, because it's taking away the affordability again to another level.
Yep. Yeah.
But as prudent investors have been watching the single family home market rising the way it has because land is hard to get, they're now realizing that this itself is a great pool to be investing in and controlling.
Mm-hmm.
And so you'll probably start to see groups buying where I might be a crowdfunder. So
Right.
I might put in $1,000 or $10,000, or they'd be sold in units. But the idea of me owning my own single family home, again, as a young person, may not be there. It may be I'm part of these pools. And so this is a trend that's going to start to continue.
Very interesting. Yeah, I presume in Canada it's much more nascent than in the U.S. In the U.S., I see a lot of political risk to that strategy because it's big and it's definitely affecting the availability
For
for
sure.
non-investors, and there's not enough, and housing there is also very expensive. Here, I presume it's more marginal, so it can probably fly under the radar for a little while. So those are my big questions. Harvinder, is there anything that I missed?
I think you got the big issues, Joe. If I would just want to repeat or emphasize something, I think we are in the midst of a cyclical decline in housing, and it's healthy. As Christopher said, things just gotten too crazy. We need to reset, not just on the housing market, but on the economy with very elevated inflation. So it's a nice, natural resetting, cleansing process. And it need not lead to a big collapse in the economy and the financial system the way we had in the US. And once the adjustment process works its way out, we'll start the next cycle from a healthier level.
And how about you, Christopher? Is there anything that I missed?
Well, one of the big things that I've been curious about is in Japan, they have what's called a century mortgage, where the amortization is 100 years. And they had to do this because nobody could afford I remember the Kramer film with the dresser drawers, every home in Japan is so small because you can't afford it. So I see the need at some point to extend the amortization of mortgages in order to make them affordable, just because this is the new era that we're in. Prices, historically, whenever there's been a correction, they go down 10, 20, 30%, and then the next increase is higher than the last one. So I think if we're going to be facing higher prices long-term over the next, let's call it 10, 20 years, we may have to start looking at a 50-year amortization.
If I could just chime in there, Joe.
Sure.
Like, it will certainly, of course, help affordability by making monthly payments more manageable for people. But at the same time, you're stimulating demand in an already overheated market. It's not the long-term solution. The long-term solution is on the supply side. We've got to get more supply, more building, whether it's in the cities, greater concentration, or we got to build these new villages, as Christopher was alluding to. But policies that keep stimulating demand are not the long-term solution.
Well, I think you've hit the nail on the head, Harvinder, because rate increases are a blunt instrument, right? And so because of the nature of inflation, there had to be some substantial and quick rate increases. And one of the impacts of that is the new housing supply and those things that are permitted, but in the development stage, it stopped. They've stopped much of that development, and so I think that you're both right in the sense that the solution to this won't be so much of a Bank of Canada. It will be a government saying, hey, let's work together and let's get permits in some of these smaller towns where land is still cheap. I mean, Canada has a ton of land. Anyone with global warming and the Northwest Territory, we're all set. Or some of the things in terms of just, building and permitting, which a lot of parts of government tried in the US and Canada over the last cycle. It didn't work that well, but I think it's a government solution. Interest rate increases are blunt, and so if I looked at how it impacts the whole economy, the housing's going to get hit the hardest because it's the most sensitive. And coming into this, home prices to rent, home prices to income. I mean, they took out US 2006 housing bubble peaks a long time ago, and we just kept going. So I think I have to say it's a supply. It's got to be a supply solution, and maybe pandemic has made it so that not all the immigrants will want to go to downtown Toronto and Vancouver core, and that could, from a demand perspective, that could also speak to your vision of the future, Christopher. Any other thoughts on how we might get out of this?
Well, I wish we had more sensible government policies, but unfortunately, I don't see that. We're having an election here in Quebec, and I forget which of the parties it was, but one of them wanted to put a pause on what we call the welcome tax, which is the land transfer tax for first-time homeowners. So all this stuff does is, again, just stimulates demand, but they're not having any policies to increase supply. So they do a lot of lip service that we want to build more affordable housing and we want to do this and that, but we see very little. Most of the policies that we see is just to keep stimulating demand to be able to afford these higher prices. And once it just keeps pushing up that home price to income ratio.
It's self-limiting. And how about you, Christopher? Any other solution besides?
Well, I think the stress test had its place when rates were really low. So the stress test, I think, should be off the table. I think if the banks pulled that off right now, because the rates are high enough. If you have to add 2% more to the ability to afford the renewal on your mortgage or a new mortgage, I think that taking the stress test away will actually give some relief to those that are trying to borrow and make their mortgage payments.
If I could just add, I think the risk of that policy is that if you take something away, you're going to keep the economy hot. And what that would actually mean is that the Bank of Canada will have to raise rates even more. So you're giving something to homeowners by getting rid of or potential homeowners by removing the stress test. But on the other side, you're going to get a Bank of Canada that's probably going to be raising rates more. And they're going to offset each other.
Good point. Yeah, there you go. So keep it in just once they see the curve happening, then they'll moderate or potentially bring rates down. I would hope in a couple of years.
Okay, so maybe just to summarize the discussion today, which again, it's really unusual to see such a strong and well-spoken perspective from the bottom up and from the top down together, because usually you see one or the other. It seems like there's a consensus that the next year or so is going to be pretty rough because the Bank of Canada is going to probably overdo it. And even right now, from Christopher's perspective, the various things on top of the Bank of Canada make financing already difficult, that we are likely to end up somewhere between a mild and, let's call it more than mild, price decline over that period, but unlikely to run into the sort of self-feeding disaster that we saw in the US 15 years ago, because the banks should be able to stay safe, which ends the vicious cycle, which actually the same thing also happened in Europe in 2012. So things act differently without a banking crisis. They're a little bit more like the luxury market, where things are fundamentally driven rather than massive forced selling, begetting forced selling. And that if we look beyond this 1 or 2 or 3 year period, the intermediate term outlook looks pretty good because we fundamentally don't have enough housing supply to match past demand, not to mention the acceleration in immigration that we're seeing in the current government, and the fact that all of these super smart tech immigrants are no longer interested in going to the United States. They're much more interested in coming here. So, there will be a point, maybe we'll have another one of these in 6 or 12 months, when we can say, back up the truck, it's time to buy, because the long-term outlook is pretty positive. How does that sound, guys?
That sounds real good. Yeah.
All right. Thank you so much. It was really fantastic. I think our clients are going to get a lot out of this.
Wonderful.
Thank you so much.
Thank you, Joe.
Thank you, Joseph. Thank you, Harvinder. Nice to meet you.
Likewise, Chris. Thank you.
All the best.